For this session, we will be talking about adjusting entries accounts for financial statements, specifically prepaid expenses. So we would like to explain and prepare the adjusting entries for this topic, for this video about prepaid expenses. Let's define first what are the types of adjusting entries that are relevant for our financial statements. So you would have 5 adjusting entries, namely prepaid expenses, depreciation, unearned revenue, accrued expense, and accrued revenue. So prepaid expenses, to define, this refers to costs paid for in advance of receiving their benefits. So in this first sentence, it tells you that these are what? These are costs paid in advance of receiving their benefits. Okay? Also, these prepaid expenses, although you are seeing the word here expenses, this should not be noted as part of your equity item. Okay? Because you will be mistaken, you will be confused. But rather, read it as the entire account title of prepaid expenses. When you see this account title, prepaid expenses, you would always classify this as an asset. As it says in the second sentence, prepaid expenses are assets. As these assets are used, their costs become expenses. Okay? So it says here that initially, these are assets. Okay? At initial recognition. But over time, or as you use these assets, this becomes part of your expenses. Of course, you use a portion of your prepaid expenses or passage of time happens, so you would need to take out the expense portion of that of your asset or take out the expired amount on your prepaid expense. So the common types of your prepaid expenses would be your insurance, rent payments made in advance, and supplies purchased for use in the business. For this video, we will be focusing on prepaid insurance, okay, and supplies. When the payment is initially made, it is important for business to capture these costs as assets, labeled as prepaid expenses. So for every prepaid expense that you have, such as prepaid insurance, prepaid rent, and supplies, this will be classified under the basket of prepaid expenses. The benefits of prepaid expenses are utilized within a year. Thus, they are classified as current assets. The adjusting entry comes into effect at period end when these assets have been depleted through direct usage or usage due to the passing of time. So as mentioned in this slide, there are three common types of prepaid expenses, such as your prepaid insurance, prepaid rent, and supplies. So for your prepaid insurance and prepaid rent, this would fall under the passing of time. You have here insurance, and you would have here rent. So that is an example of your passing of time. For the direct usage, okay, an example of that would be your supplies. In the succeeding slides, we will be discussing what is the approach when we analyze direct usage and how do we recognize the passing of time. Okay, so I have here the two types of accounts that are affected when you perform an adjusting entry for prepaid expenses. Adjusting entries for prepaids, okay, involve what? You would need to increase your expenses. Again, the normal balance of expenses would be on the debit side. And also, you would need to adjust the balance of your prepaid expenses by decreasing your asset. And how do you decrease your asset? You record any amount that are decreases on the credit side. Okay? So in this table right here, you would see that there are two T accounts. You would have one T account for your asset, okay? And you would also have one T account for your expense. So on the left side of the asset T account, you would see here the unadjusted balance. So typically, this would be the original cost of your prepaid expenses. So you will put in here the cost of any prepaid expense that you purchased. Okay? So say, for example, you initially started at, let's just date this as January 1. Your balance of your prepaid expenses is $1,200. Okay? And by the end of the month, okay, through inventory count or through the passing of time, you determine that $100, okay, has already been expired, or $100 has already been consumed. So what you need to do at the end of the month is you would need to reflect the current balance. Okay, and how do you do that one? Just decrease your asset amount by the expired portion, or by the consumption. So let's say, for example, again, I told you that the expired amount or the consumed amount was $100. So on the credit side of your asset, you would put here a credit amounting to $100. Okay? And again, to update the balance of your asset, you just simply need to deduct your debit and your credit amounts. In this case, your your balance for your asset as of January 31 would be 1,200 minus 100 would be $1,100. Okay? But you don't stop here. You just don't make updates on your asset T account, but rather you also adjust, or you also update the detailed record for your expense. Okay? As you can see here, on the asset side, it says here you have a credit adjustment. Okay? And that credit adjustment will be transferred to your expense account. So in this case, we recognize that our prepaid expense decreased by $100, okay, as a result of a passing of time, or this was the amount that was consumed. So this $100 should be reflected now as an expense during the month. So I will put in here on January 31, an expense amounting to $100. So there are several questions that may arise to this. First question is, how much did the asset decrease? So if that is the question, then the answer there would be $100. Second question is that how much is your prepaid expense at the end of the month or at the end of the period? Then the answer would be deducting your unadjusted balance, okay, your 1,200, by your expired amount of $100. Then the answer there would be 1,100. Okay? And the final question, okay, that you may be anticipating is that how much was the expense that you incurred during the month of January? Then the answer there would be $100. Okay? So in this screen, we are now focusing on the prepaid expense specifically for prepaid insurance. So there are two transactions that are happening here. So first one would be your recognition of the purchase of the insurance policy. So let's read the transaction. It says here, we paid $2,400 in the form of cash for a 2-year insurance policy on March 1, 20X3. So again, the first step of the accounting cycle is to always analyze the transaction. So when we analyze this, we ask ourselves, is this transaction a financial transaction or a non-financial transaction? So reading this transaction, it seems like this is a financial transaction because of the following events. First, you paid $2,400 in the form of cash. And you paid cash in order to purchase an insurance policy on March 1. Okay? So now that you've determined that this is a financial transaction, your second step is to get the pertinent accounts that are affected or are necessary in order for us to prepare an adjusting entry. Or a journal entry. Okay? So what you need to do on the first bullet point is to get, again, the necessary accounts for your journal entry. And that would be cash is involved, and then your insurance policy, which we can also call as your prepaid insurance. So to further analyze this, we need to think what happened to our cash. Did it increase or did it increase or decrease? And what happened to our purchased prepaid insurance? Did it increase in value or did it decrease in value? Okay? So it says here we paid $2,400 cash for an insurance policy. So what happened is that we bought a new asset in the form of prepaid insurance. So our prepaid insurance account will be increasing. So this is a new asset, right? However, we paid for our insurance via cash, and cash is an asset. So what happened to our cash right here? Our cash account decreased. Again, if we're talking about assets, if you want to increase our assets, it will be shown on the debit side. And any decreases on our assets would be on the credit side. So now that we've already completed our analysis, we've already know what should be the debit and what should be the credit. Let's now formally write a journal entry. Again, the journal entry consists of five components. It would be your date, okay, the date of your transaction, your debit account, your credit account, the proper amounts to be recorded, and an explanation of the transaction. Okay, so for bullet point number 1, we need to put the date of the transaction, which is March 1. And then we will debit the prepaid insurance because it increased our asset. That is what we actually purchased. So a debit in the prepaid insurance. And then put the amount of the insurance. And in this case, it is worth $2,400. So put it on the debit side. And we will credit cash because our cash decreased as a result of our purchase. That's why our cash here is indented to the right. And then also put the amount of cash that we spent on the insurance policy, which is also the same amount for $2,400. Again, to complete the journal entry, we need to write, okay, or to document the nature or the context of that transaction. In this case, to record purchase of insurance for 24 months. So this is now what happened when we initially purchased our insurance policy. Okay? So now there will come a time, okay, wherein we have to close our books, okay, or when we are preparing our trial balance, we need to perform adjusting entries to reflect the correct and accurate amount of our account balances. In this case, we are concerned in determining the adjusted trial balance for the month of March. So, what we need to do by the end of the month, specifically on March 31, we need to get or we need to understand how much of the prepaid insurance has already been used, okay? And how much should we recognize as an expense, okay? So now, again, let's perform the first two steps, okay, of the accounting cycle, which is analyzing the transaction and journalizing it, okay? So it says here, 1 month's insurance coverage is used, okay, 1 month, causing a portion of the asset prepaid insurance to become an expense, okay? So you might be wondering, why do we need to get the expired portion or the expense amount of our prepaid insurance? Because again, every when we are preparing our trial balance, we need to prepare adjusting entries to properly record or to properly represent the true amount of our financial statements. In this case, we would like, in a way, we would like to prepare the adjusted trial balance in order to produce the financial statements. So what we need to do when preparing the financial statements is to show to the users of the financial statements that whatever the amounts that are reported in that report, okay, are final and are all updated. Okay, in this case, going to finalize our adjusting entry, we just need to get, or we should know, how much time has already been consumed. So again, we purchased this on March 1, and now we would like to get the updated balance as of March 31. So 1 month has already been lapsed. Okay? So how do we get the expired portion of our insurance policy? First thing that you need to do is to get the life of the insurance. How many years or months is your insurance policy good for? In this case, it is good for 2 years. Okay? And since we are assessing on bullet point number 2, we are assessing the monthly. Okay? We would like to get the updated balance after 1 month. So we need to convert these 2 years in the form of months. So 2 years, there would be 24 months. Okay? So now that you've already know that you have 24 months in 2 years, you just need to get now the monthly expense or the monthly decrease in your prepaid asset by dividing your prepaid insurance amount, 2,400, by the life of the insurance, 24 months, you would be getting $100 per month as an expiring amount. Okay? So now that you already have this analysis, what you need to do right now is to decrease the value of your asset. And how do we again decrease the value of our asset? We will be putting it on the credit amount. And also, that decrease in your asset will constitute or will signify as the expense that you incurred during the month. So to formally write the adjusting entry, you would need again to write the 5 components. First thing that we need to do is put the date of our adjusting entry. In this case, it was March 31. And then, what happened? If you focus here, the $100 per month, this now signifies, or this represents the expense amount for the month of March. So you would be debiting insurance expense with the amount of $100. Okay? And then this insurance expense has an effect of decreasing your asset amount or your asset account. That's why you credited here prepaid insurance amounting to credit $100. And the story of this transaction is to record the expired insurance. Okay? So now that you've already journalized this, you've already know that, okay, we have debited insurance expense because we want to increase our expense account. Okay? To signify that 1 month has already been used up. Okay? And then we will be decreasing prepaid insurance, which is an asset account, to reflect the updated balance of our asset account. What you need to do for every journal entry that you write, okay, or adjusting entry that you prepare, you would need to reflect this in your ledger. You would need to post this in your ledger, the detailed record. So in the next slide, okay, you will see here, okay, that you are maintaining 2 types of accounts. Okay, you would have here your prepaid insurance and your insurance expense. Let's focus first on the prepaid insurance. So you would see here that on March 1, you initially purchased the insurance policy for 2,400. That's why it's on the debit side. You increased your asset. Okay, so you increase your asset here. However, by the end of the month, on March 31, you would need to update the balance of your prepaid insurance to reflect the correct balance as of month end. So again, we determine that the monthly expired amount is $100. So in the credit side of your T account, you would be putting $100 to show the decrease in value by $100. Again, for the asset account, just subtract your debit and your credit. 2,400 minus $100, you would be getting 2,300. This would be your balance as of March 31. And then your prepaid insurance, the expired portion of this one, the decrease, this $100, will be now recognized as an expense, which would fall under your equity item or in your income statement. So you would have an insurance expense amounting to $100 by the end of the month. So class, this is an example of passing of time. I've mentioned a while ago that there are two types of expenses that happen. So it may be through direct usage or passing of time. In this case, for the prepaid insurance, this would fall under the type of passing of time, because you cannot you cannot assess how much insurance you already consumed, right? This is not in quantity, but rather this is through a time frame. And in this case, your insurance is good for 2 years. So every day that goes by, every month that goes by, every year that goes by, what you need to do is to decrease it. So initially, on March 1, okay, it started on $2,400. But as the day goes by, let's say on December 31, this will have a smaller dollar amount, because every day that happens, or every day that comes, it will be decreasing to 2399, 2398, and so on up until it becomes 0. This is an example of your passing of time. In this slide, this is now an example of your direct usage. Okay? So we will know later why this is an example of direct usage. But first, let's analyze the transactions first. So let's focus on bullet point number 1. It says here, we purchased $2,500 worth of supplies by cash on March 1. So to analyze this transaction, let's first determine whether this is a financial transaction or non-financial transaction. Okay? So we purchased $2,500 worth of supplies, and we paid cash via to make this transaction effective. The supplies and cash, okay, were affected. Okay, that's why we call this, or we classify this as a financial transaction. Okay, now that we've determined that this is indeed a financial transaction, let's now know what are the accounts that are affected. So the accounts that are affected here would be obviously your cash, because you paid cash for it. But what did we purchase as a result of this cash transaction? So we purchased supplies. Okay? So let's say this supplies is your paper. All right? So this would be paper supplies. And it amounted to 2,500. And both supplies and cash are assets. But first, let's determine what is the effect of our cash transaction and what happened to our supplies account. Okay? So to dig this deeper, it seems that we purchased $2,000 worth of supplies. And what happens when we purchase supplies? Our supplies account increases. Okay? And then we paid cash to make this sale possible or to make this purchase possible. So when we purchase something via cash, what happens to our cash account? It decreases. So now that you already know this and both are asset accounts, so any increases in your assets would be displayed in the debit side, and any decreases in your assets will be shown on the credit side. So now that you've already completed your analysis, you now need to prepare your initial journal entry. So your journal entry here would be, again, put the date of transaction. It will be March 1. And then debit supplies amounting to 2,500, which is the amount of supplies that you bought. And also credit cash for the amount of 2,500. Okay? So this is now your initial journal entry. And the context of this transaction is that we purchased supplies for cash. Okay? So now again, what we're already on the end of the month and we would like to get the updated balances of our accounts. So on bullet point number 2, it says here that on March 31, on the end of the month, we determined that we've already used or we already consumed $1,050 worth of supplies. Okay? Used $1,050 worth of supplies. So you might be wondering, sir, what should be the correct expense for this one? What is the keyword in order for us to determine that this is the amount of supplies that we've used or consumed? So on bullet point number 2, it already expressly mentioned that we already used up or we've already consumed supplies amounting to $1,050. Okay? So this $1,050 worth of supplies would represent as a decrease in our supplies account asset, and this $1,050 would also be our expense for the month. Okay? So let's now perform an adjusting entry to satisfy the supplies account. So again, write the date of the transaction. The date of the adjusting entry is March 31. And we already know that this $1,050 is the expensed amount or the consumed amount of your supplies. So you put in here debit supplies expense amounting to $1,050 and decrease the balance of your supplies asset account by $1,050 to credit supplies $1,050, and then write a statement to satisfy or to provide context on the transaction. In this case, it is to record supplies used. Okay, so for every journal entry again that we prepare or adjusting entry that we prepare, we should update our ledger. So we will update the detailed record of these accounts. In this case, we have supplies and supplies expense. Supplies would be an asset, and supplies expense would fall under equity, specifically expense. So in your asset account, in your asset T account, initially you would put in here on March 1, okay, the amount that you purchased, the opening balance. It is $2,500, okay? But again, on bullet point number 2, it told you that $1,050 has already been used up. Okay? So the used up amount or the consumed amount, you would need to decrease it in your asset account. So this $1,050 would be the decrease in your asset account. That's why it's on the credit side. So to get the updated balance of your supplies as of March 31, just simply deduct your $2,500 minus the supplies that you've consumed already for $1,050. You would get an updated balance of your supplies asset account of 1,450. Okay? So again, for the decrease in your asset account would also be the recognized expense, okay, in your supplies expense T account. So this value, the credit adjustment that you made on your asset account, transfer it or record it also in your expense as a debit adjustment. Okay? So again, there would be three questions here. My first question here would be, how much was the decrease in your asset account? Okay, if you're talking about how much is the decrease of our asset account, then the answer would be we credited $1,050 in our asset account. That's the first question. My second question would be, how much is your supplies account as of March 31? So the answer there would be 1,450. How did I get 1,450? I subtracted 2,500 by 1,050. Okay, so it's the second question. And my final question here would be, how much is your supplies expense for the month of March? Then the answer here would be $1,050 because that was the consumed amount for the month of March. Again, this type of transaction that we just exercise is under the direct usage. So there are other prepaid expenses, including prepaid rent, which are accounted for in exactly the same manner as insurance and supplies. We should also note that some prepaid expenses are both for and fully used up within a single accounting period. One example is when a company pays monthly rent on the first day of each month. The payment creates a prepaid expense on the first day of the month that fully expires by the end of the month. In these special cases, we can record the cash paid as a debit to the expense account instead of an asset account. So in this session, particularly prepaid expenses, we've determined that adjusting entry would be prepared through direct usage or passing of time. So the passing of time, the prime example that we did was the prepaid insurance. Initially, on the start of the month, which is March 1, we purchased insurance amounting to 2,400. Okay? And then every month that passes by, we need to take out the expired portion of that insurance. Okay? That's why we call it passing of time. For supplies, however, this would be an example of your direct usage. So in the direct usage, you actually can determine how much or what is the quantity that you've already been consumed or the amount or the quantity that you've already used up. In this case, on the example of our supplies, we purchased supplies or paper amounting to $2,500. And by the end of the month, we determined that from March 1 to March 31, we've used paper amounting to $1,050. So that $1,050 would now be recognized as part of your expense under your supplies expense account. And that decrease, $1,050, will be taken out or will be deducted from your supplies asset account. Okay, so again, those were the highlights for your prepaid expense primarily. So if you have any questions, please feel free to comment or feel free to raise it during our class. Thank you.